Thank you, Jan. Thank you very much for your time to do this.
Lovely to be here.
Let's start from the trade agreement between China and the US. Many people believe that it's only a temporary truce rather than a lasting peace. Do you agree?
Well, it's for the next 90 days, so in that sense, it's true. There is quite a lot of uncertainty still what happens after the 90 days. And I think there are opportunities of maybe seeing further declines in trade barriers, but there are also risks that you get a re-escalation if an agreement can't be found in that 90 days. So it's quite right to say that this is not a permanent solution, but it does give us some breathing room. It was better than what we expected. So I'm focused in the first instance on the fact that this was good news, but only on a preliminary basis.
The tariffs peak now very much is behind us. So what is your expectation of the tariff now?
The peak on US-China is very likely behind us. Yes, I agree with that. I do think there are some other areas of US tariff policy where we probably still see some bad news. We are expecting, for example, an increase in sector-specific tariffs on pharmaceuticals and tech equipment and a few other categories. That is very likely to happen. I think there are also risks to US tariffs on other countries, Europe in particular. I think there's at the moment a 10% tariff on Europe, but that could go up. So I think it'll be a very fluid environment still. And while the last several pieces of news have been on the positive side, it doesn't mean we're out of the woods yet.
Now, the tariff level in the United States is the highest since the 1930s. So what is the long-term effect on the US economy of the tariffs?
Well, I think it's probably a negative impact, certainly on short-term growth. We're estimating that if you do get a 13 percentage point increase in the average US tariff rate on all goods imports. That's our current working assumption. When we think that's going to shave about 1 to 1.5 percentage points from US growth in the next year or so. And we also think that that probably isn't going to come back in subsequent years. We're skeptical that there's going to be a big long-term gain that offsets the short-term pain. Now, this pain is more moderate than what we had thought a few weeks ago, right after April 2nd, but there's still going to be a negative impulse to growth that comes through the fact that a tariff is a tax, so it eats into households' disposable income. It does have probably negative effects on financial markets, although those now look smaller than they did 4 weeks ago. And the uncertainty around where policy is ultimately going to settle is probably leading firms to postpone investment spending, and that weighs on growth as well.
But after the China truce between the United States, Goldman Sachs reduced the probability of the recession of the US to 35% from 45%. And now the US stock market is trading like the Liberation Day shock has never happened. So does that mean the so-called Trump put is back in place?
Yes, I think there is a little bit more of a sense of a Trump put in terms of what's happened over the last 4 to 6 weeks, that markets became very disrupted. And it wasn't just the stock market, but also the currency market and the bond market. And that, I think, has led to policy shifts and in some sense personnel shifts in the Trump administration, with a more prominent role for the Treasury Secretary, that I think are in part driven by this and that are more market friendly. And that's put us into a better place than where we were 4 or 6 weeks ago. With that said, 35% is still a pretty big number.
Yes.
The average recession probability over the long term is about 15%. We've seen about 1 recession every 7 years. So 35 is more than twice as much. And again, we're not out of the woods yet.
As 2025 underway, the US dollar shows the signs of weakening. In your most recent piece on Financial Times, you said that the dollar has further to fall, a very bold call especially, and you also recognize that you always dodge the question of the direction of the currencies. So why you make such a bold call?
I think there are basically two key points. One is the dollar is at a very strong level. On a broad trade-weighted basis, if you go back 50 years, we're at one of the highest levels of that 50-year period. We're 20% above the long-term average, 2 standard deviations above the long-term average, and there are only 2 instances, the mid-1980s and in the early 2000s, when we were at similar levels. Both of those instances were followed by a broad trade-weighted dollar depreciation of 25 to 30% in subsequent years. And number two, the United States is running a very large current account deficit of about 4% of GDP. That means the US needs about 4% of GDP in capital inflows, basically foreigners buying US assets on net of about 4% of US GDP. And in our view, in an environment where the US economy is not outperforming other advanced economies by as big a margin as the last couple of years, we expect that it's going to be harder to get that 4% of GDP of net capital inflows without some valuation adjustment, probably a currency valuation adjustment. But I recognize that forecasting currencies is very difficult. You can't, of course, say that you're certain of this, but I think there's a good likelihood that we'll see a weaker dollar in coming years.
But you also said the baseline of the recent weakening of dollar will not undermine the dominant status of US dollar in the global financial system. But many people argue that the pillars underpinning greenback's dominance, such as trade, such as alliances, such as the independence of the Fed, are all being challenged by this administration's policies. Do you agree?
Well, I do think that there are some concerns and there are some forces that may over time reduce the dominance of the dollar. But when I say over time, I'm talking about multi-year or maybe even multi-decade developments. I think the entrenched forces that underpin the dollar dominance are still pretty strong. And those entrenched forces are that the dollar is almost like a language, that it is a convention to do invoicing and accounting in dollars. These are all things that we're watching for sure, but my baseline is that while there's a likely depreciation of the dollar, it's not going to undermine the dollar's position as the world's most important currency.
Maybe this is not the end of the dollar dominance. Can I say that, is that a start of the end of the dollar dominance?
I think that is a little bit more terminology and semantics. I do think that the extent of the dominance is probably receding, and we are seeing that in terms of reserve shares, for example, in terms of diversification by central banks out of dollar reserves into a broader set of currencies. I think that's also one of the reasons for the strong performance of gold, because central banks have accumulated more gold reserves. So I think it is moving in that direction. But what I would emphasize is that this is a gradual move and a relatively slow move that is probably going to take a long time. And I go back in economic history to dominant currencies. The pound sterling in the 19th century and first half of the 20th century outlasted the dominance of the UK economy, of the British economy, by many decades. So it takes a long time for a currency, a dominant currency paradigm to really shift.
You put the TechNet conference here in Shanghai, mainland China, for the very first time. How would you evaluate the innovation capabilities of China now?
Well, I think what we're seeing is that China has really moved up the value chain in terms of innovating. It was imitation at first, it was process innovation maybe next, but there are more fundamental innovations coming out of China now than I think many market participants would have expected 5 or 10 years ago. And there is a lot of innovation in the tech ecosystem in China, AI in particular, robotics. We have seen a lot of advancements. And I think the fact that we're having our TechNet conference here in Shanghai after being in Hong Kong for many years is also a recognition that something has changed in terms of the innovation that's coming out of China, and we want to be closer to that. So these things go hand in hand. And from an economic perspective, and of course, I'm not a tech analyst, I'm an economist, but from an economic perspective, that is a source of domestic strength that offsets some of the headwinds.
Final thing, Jan. Last January in Davos, you told me the 200-year-old theory of David Ricardo. Trade between countries is not a zero-sum game, and trading with one another can make both sides better off. You said that this 200 years old theory is still very potent, very powerful these days. But things are very different on the ground. So what should we do?
I think the theory of comparative advantage by David Ricardo is probably one of the top 3 insights in the history of economic thought, that zero-sum thinking understates the opportunity for mutual advantage. This is important, I think, for economic policymakers. Of course, as an individual, as an entrepreneur, as a worker, it's very natural for people to focus on their own advantage. But the beauty of the invisible hand in economics and comparative advantage is that in a market economy, in an economy where people can exchange ideas and exchange goods and services, that can make all of us better off. And that would be my takeaway.